So far we have discussed the balance sheet of the startup transactions. Now we'll move on to a normal business course, which also reflects the business to earn a profit, which is, in a simple terms, a difference between revenue and expense transactions. Revenue are inflow of assets in exchange for providing goods or services to customers. So let's go back to our example. Let's assume that Jacob's Tennis and Golf has rendered a service to the customers for providing golf lessons for the amount of 600. So how we will recognize this? Considering that the customers paid 200 immediately by cash and 400 will be paid in February. So we recognize these both transactions as assets. So let's number this as a 6th transaction. So what's affected? Basically we have cash increase by 200, and also accounts receivable, which is a short-term receivables for the services that the company has provided for it. So it's 400, and also we have a increase in Jacob's capital by total of 600. So you may ask why there's an increase in the owner's equity. You may see that this transaction hasn't affected our liabilities. So in order to balance the asset side, we need to increase logically the owner's equity, and this is the reward actually the owners of the business get, because if the company is involving in a profitable business, then all the profits are going to the owners. So let's see how it works in accounting. Important point in here, as you may see, the revenue that we have earned of 600 does not actually equal to the cash that we have received. So it's important to note that accounting revenue is not always equal to the cash that actually the company received. Let's assume another case when, for example, Jacob's Tennis and Golf has rendered a service at the end of January and in the beginning of February, but it has received the cash for this service. Let's assume it's a transaction 7 in the beginning of the month. So partially, for example, the total was say 200, and it has received 100 in the beginning of the month, while the service was actually rendered at the end of the month. So how will we recognize this revenue? So revenue recognition principle actually assumes that the revenue is recognized only when the product is delivered or the service is rendered. That's why in the beginning of January we can only input this transaction. So we have increase in cash of 100, and we have a liability which is unearned revenue, also 100. You may ask why it's under the liabilities category, but important thing in here is to note that we have received as a business a payment, but we are obliged to do this service in the future. So we have received, in this case, we have received the money in the beginning of the January, but we need to we have a liability to render a service at the end of the month, and when we will actually deliver this service, then this unearned revenue will be credited, and this revenue of 100 will go to the owner's capital. Now let's touch the second part of profit making, which is about expenses. So expenses occur when the resources are consumed. So for example, let's say that during the sales for the January, the total wages of salespeople was 700. So how will we recognize this? Let's label it under transaction 8 and see what happens. So we have actually paid to our salespeople by cash. So the cash has decreased by 700. And also owner's equity has decreased as well by the same amount, as we recognize it as a salary expense. Let's assume another example for expense. For example, we have the expenses for the 120 for the utility. How will we recognize that? Again, it's important to note that what transaction accounts have been reflected by this transaction. So let's assume that Jacob's Tennis and Golf office space utility expense was 120, and we decided not to pay it immediately, but we have a liability. So first we recognize the label of this transaction as a 9. So let's say that we have we didn't pay it with cash, and we decided to pay it in February. So but we have a liability, utilities payable for 120, and we also recognize this expense even though we haven't paid by cash, but we recognize it as a decrease in owner's equity. So as you may see, we again have a balance, and we have recognized this expense even though we haven't paid it. You may ask why we have actually put this indicated as a expense even though we haven't paid it. Because simply that we have already a liability arisen in order to pay this today or in the future. This is our expense. So another question is whether we pay it now or then, but when we will pay it, then assume that it's already February, and the 10th transaction will be like this. So we have a cash decrease of 120, and we have a utilities payable decrease because we have actually paid out this. So again, minus. Again, you see we have a balance, but we have already recognized this liability in January because that was for January, and we have received the bill for the utilities company at that time. Now move